Good morning, folks. This is the 5th of August, early morning, and I'm trying to do a little weekend analysis of what's in store for us in the coming week. And there's been a global turmoil. The Japanese markets have fallen, and there's a resultant shift in sentiment all over the globe. The US has fallen, and we were standing really strong until Friday, but I think overnight, after digesting the news that's coming in from all over the world, even we are looking to open gap down on the gift Nifty, and it seems that we are opening close to 300 points lower. That's a major fall. That's a 1% down without any action, and just opening 1% down. So yeah, there is basically some more expectation that it might go down further. And if you've seen the last 2 weeks analysis, now we are definitely in the red trajectory as far as the markets are concerned. And we need to understand what are the levels that we can look at. So if you see the chart here, this seems imminent, 24,293 on the futures chart. Looks imminent today or maybe in the coming days. And then we could go to that 24,140 level, which I was thinking was something that was possible in the budget week. So we have gone into the red territory, and finally this market is giving some correction moves. So the correction was overdue. We were wondering why the markets is not giving a correction, and everybody was talking about that the market looks overheated, and but this is not basically pushed by the Indian news or anything to do with India. It's more global, and I think we will finally get the correction, and it could go deeper. Situation is not very good. The Japanese yen carry trade is the reason for all this trouble. Now, in a nutshell, it would be a long story to explain to you, but basically Japanese yen carry trade was a very simple trade. People used to borrow money from Japan, banks in Japan, at a very low interest rate, and use that money to put in use other places in the world where the interest rates were higher, and that was the differential was what was called the Japanese yen carry trade. Now, what has happened is that the Japanese yen went from 100 to $1 to 160 to $1 very recently. And then the Bank of Japan raised the interest rates sometime back. And that caused, the yen was really sinking, and the Japanese government had to do something. The Bank of Japan made a move, and to attract money back from overseas into the Japanese economy, they increased the rates. And what that resulted in was it did work, and it brought the Japanese yen back down to 140. Now a 10% differential makes a huge problem, because when you borrow money at 160, you take it out, and when the Japanese rates went up, if some money has to come back into Japan today, when it's going to come back into Japan, it has to come back at 140. When it went out, it was at 160. So there's a huge amount of disturbance in the currency markets, and the carry trade is totally distorted, and it's in a bad shape. And this contingent has created a problem, because if the Japanese money was some kind of liquidity for the US markets, and if it has to be pulled out, that's going to cause some selling in the US markets, and that's what we're seeing. We're seeing things like Nvidia, Microsoft, Google, Meta not so much, but Amazon, and all the big guns there have shed a lot of liquidity. So it is not anything to do with the fall in the AI sentiment. It's got more to do with the structural problem that the Japanese, raising of interest rates, and the problem to the Japanese yen carry trade. That's what is resulting in all of this. Now let me go to Bank Nifty and give you some perspective as to what we expect on Bank Nifty. So yeah, if we fall on the Bank Nifty into the red territory, we should see 50,370 soon, and then maybe 49,300 is what could be our ultimate destination in the current scheme of things. Now, we could probably know what is in store, but for the current week, I think 49,300, first station 50,370, and then 49,300 is something which is very, very possible. Now, I'm not saying that it's going to come. We might see a reversal in the markets after it opens. But even if the reversal happens, trust me, the sentiment has gone sour. And when the sentiment goes sour, the markets really give way. However much liquidity that you might get in the Indian economy, I think we're reaching a stage where things are getting out of hand and they're looking overvalued. Now, if they look overvalued, there's absolute space for things to correct back and come back into reasonable territory, value territory, where the long-term investors can, make their purchases for the long term. Because currently, whenever you talk to somebody, if I were to talk to somebody, I would be very skeptical to give them advice to go and buy stocks for the long term. You can buy stocks for short term, like a 1 or 2 months of rally. But if your aim is to go for a 6-month holding period or a 1-year holding period or multiple year holding period, it would be a difficult scenario to buy into. SIPs are not affected because SIPs, the nature of the product gives you an average. But if you're buying stocks for long term, that was something that many people were very uncomfortable, and people are not going to the equity markets in a big way. So this is what we're looking at. Let's see what happens at the open and through the day. Probably that'll give us more cues. But as I always repeat, look at the levels, look at the markers that we have on the roadmap, and decide as you reach those levels for the next course. You always have to trade with what you see and never trade with what you think or what you want to predict. And predictions don't work in this market. The only things that work are understanding what levels are possible, the awareness of what is possible, and move according to what the market gives you. And react dynamically in such a situation. When the volatility is there, you have to react dynamically to be a part of the trading activity. If you cannot be dynamic, if you cannot be on the screen and cannot be trading, avoid trading these days, because trading in these areas at times, because anything can happen. You cannot predict anything. So that's my call for this week's analysis. We will do a little more after we see the open and some reactions. But yes, we are looking at a weak start and a difficult time for long-term holders. As far as the day traders are concerned, the gap down doesn't allow you to take advantage of the fall. That's exactly what happens. When the market falls, it gives you very little opportunity. And unless you hold overnight, it cannot give you long trades. It just, you're looking at small cycles. You're looking at small cycles to make money. And unless you carry the trade to overnight, you really can't score big in these falls. And that's what normally happens. So, I mean, it's a difficult period, but yeah, we got to weather everything that comes our way as traders and learn from the experiences and gain knowledge and, trade what we see. So this is it for this video. Look forward to report more as we see and give you a reading on what my charts tell me. If you have liked the video and if you enjoy the value out of what you get here, do like it and do subscribe to the channel. Look forward to being with you again. Thank you.